Okay, bye.
Bye.
Um,
We are ready to begin.
Good afternoon, everyone. My name is Amir Kinchin, and I am on the board, the treasurer for the Durham Community Land Trustees. Welcome to our first concurrent session of the afternoon, and thank you for attending our session. We're going to have a great session here. There's already been some interest in other sessions about this topic. Folks are really excited about ADUs, and now the obvious question is, how do we afford it? How do we make it so we can actually buy these things? So how does the rubber hit the road? So we're going to find out today with our great panel. We have some really good folks here today. I think they may all be here. We've got Abdul Malik, who is actually a residential appraiser. We've got Susan Brown, Sarah Brennan, and Desiree Sideroff. And Desiree's already been asked some questions from earlier sessions, so we're going to be on point for that. We're going to let Sarah kick us off, and then we're going to go through, and I'm going to stop you guys about 10 minutes left for Q&A. But along the way, if you have questions and things you want to say, go ahead and jot them down in the chat section so we don't forget those questions as we go. So having said that, I'm going to let Sarah Brennan kick us off. Sarah Brennan is a senior VP at Self-Help Credit Union out in California, a colleague of mine from a while back, and she's going to start us off right now. Sarah, take us away.
Great, thank you so much, Amir. And can folks see my screen?
Not yet, Sarah.
Not yet, okay.
I just stopped my share, so maybe you can share now.
How about now?
There we go.
Okay.
You're live.
So great to be with you all, and thank you so much to Durham Community Land Trustees for organizing this session. Really excited to hear from the fellow panelists. So I think this will be educational for everyone, including me. And I'm excited to share with you a little bit about an ADU pilot that Self-Help launched in Los Angeles here a couple years ago. My name again is Sarah Brennan, and I serve as SVP here. Just a really quick 30 seconds on who Self-Help is. Some of you may be familiar. For others, we are a national, not-for-profit community development financial institution. We did start and continue to be headquartered there in Durham. We also now have a presence in 8 states, including here in California. This is our current footprint. We have 20 branches here, and this shaded area is the region that I work in. And to get to our pilot here, so you may be thinking, okay, so Self-Help is this national CDFI. Why did you start your ADU pilot in Los Angeles? And there's really 2 reasons. One is structural and one is serendipitous. On the structural side, both the state of California as well as the city of Los Angeles have over the past several years rolled out a number of streamlining responses to make it easier for homeowners to build an ADU. And this is really in response to the terrible affordable housing crisis that the state continues to face. So the idea is trying to encourage infill development and trying to use all the tools in the toolbox. On the serendipitous side, the reason that Self-Help got involved with this particular pilot as well is because we connected with some really wonderful mission-aligned partners who were already on the ground anticipating, as these laws were coming down, how we could better support homeowners. And so that's really what I'm going to be talking about today, is both who this ecosystem of partners are that we worked with in rolling out the pilot, because I think that really helps the homeowners as well as mitigates the risk for the lenders. And then I'll be sharing, of course, a bit about our product itself and why we designed it the way that we did. So the ecosystem of mission-aligned partners that I'm going to be describing really comes around, it's almost a one-stop shop, if you will, for homeowners, incorporating all of the different elements that a homeowner needs when they're considering building an ADU, right? So it's not just financing, it's everything. It's the design, it's how do you get things through the Department of Building and Safety to get your permitting? How do you select a general contractor, et cetera? And so that's really what that is about. And to share with you a little more about who these partners are that we work with and what each one does, LA Moss is an urban design and advocacy firm. They both provide the architectural drawings that we use in the pilot, as well as serve as quote unquote homeowner concierge. And this is a role that we identified that homeowners really need in order to navigate that permitting process. So LA Moss truly kind of holds the homeowner's hand, not just in connecting with all of the partners in our pilot, but also in working with the city. RNLA is a mission-aligned, not-for-profit general contractor. As folks know, so important to have a general contractor that you can trust and that's going to do great work. We, along with Genesis LA, which is another CDFI here, are the financing partners. And then finally, we have LA Family Housing and the Housing Rights Center, and they provide landlord training to the homeowners in terms of how to screen tenants and other kind of tips and tricks to make sure that our borrowers are successful in their new role as landlords. So this is a slightly different visual, but same kind of concept about how this ecosystem really works together to keep things simple for the borrower and to make sure that also we as a lender are reducing our risk, in our view, through participating in this ecosystem, right? It's a lot less likelihood that our borrower is going to select a general contractor that's not bonded or is something fly by night and just, leaves after a third of the unit is built, never to be heard from again. So in our view, this is not only such a huge value add to our borrower, it also truly does mitigate our risk. Just a little bit about the pilot product itself, self-help. We do have experience both with mortgage lending as well as commercial lending. We have never actually used a mortgage product that incorporates construction financing elements. So that was something a little bit unique about this product. I'm actually really curious to hear from some of the fellow panelists about how they approach that or if they already had construction financing within their mortgage loan portfolio. For us, the biggest piece really was making sure that we connected with our commercial lending colleagues and have a construction specialist review all the plans, review the GC bids, et cetera. And we also needed to establish a new system in place to make sure that we were monitoring and taking care of construction draws. Again, this was unique for how we're set up as an institution in our mortgage lending, and I'm curious to hear how other lenders have approached this. In terms of our underwriting itself, we are refinancing the entire note, and then we're taking the cash that is needed to construct the ADU and putting that into an escrow account that we then make payments to against certain benchmarks as the GC hits those benchmarks. We do have a range of terms available. As always, self-help loans are fixed and we do not charge private mortgage insurance. The reason I bolded some of these underwriting terms here are these really were very key to getting our borrowers qualified and are not typical, not to be found in our other mortgage loans. So the big one was definitely being able to project the future rental income that a homeowner will be receiving as they actually rent out the unit and being able to use that in our DTI calculations up front. Without that, all of the homeowners that we've been working with who tend to be low and moderate income would not have qualified. I would say another really key underwriting innovation in terms of our mortgage loan product for this pilot is that we added what we're calling revenue gap financing. And this is something actually that we did not have when we rolled out the product, but our borrowers and our interested parties sure made us aware of the need for this quick. And so that's for the period of construction when a homeowner, they're not yet taking in that income because they're not able to rent the unit since it's under construction, but they now have the higher mortgage payment, right? Since they already took out that funding for the construction. And so we're actually including that in the overall cost of the loan amount. And that way, during the construction period only, the borrower is not responsible for that difference. It's already included in the total loan cost. And some of the key learnings, this is the second to last slide, so I'll share key learnings as well as some recommendations that we have from our pilot. One is that pre-development costs can dramatically change project costs. And so in our pilot, one of the things that we did, or our partners did, LA Moss as the architect, is they had a limited number of design options. And the idea there was to increase efficiency and allow borrowers to choose, some small customizations, but not too many. However, due to a lot of site-specific modifications that were needed, and this could be anything from hillside grading to a historical overlay preservation district, it was often that we ran into unanticipated costs. So just to be mindful of that. Another key learning is that slow permitting processes really increase cost. So that's yet another reason to make sure if you're already in touch with your local municipality and they are like LA. In LA's case, we've reduced the amount of time that DBS has pledged to get back and review plans to 60 days from 120. That's going to be very, very key for the cost for the borrower and for the lender. And then finally, and this is what I'm really interested in hearing from one of our panelists who is an appraiser, is that the comparables market is just almost non-existent, and that's complicating calculating the as completed value. So I'm very interested in learning about that later in this session. Oops. Then this is last slide, just recommendations. As I've shared, we really, really recommend this pre-vetted ecosystem of trusted partners. We think that adds a lot of value to the borrower and truly reduces risk as a lender. We also really found over and over that technical support that the homeowner concierge in the pilot plays is key in supporting borrowers along. Good contractors, I've shared, is absolutely essential. And then finally, don't forget to educate borrowers up front. I think the more education we can do up front, the more likely it is that expectations are managed and people come away from the process as happy borrowers and happy new ADU homeowners. And I'll stop sharing so that the next panelist can speak.
Excellent, Sarah. Thank you. That was great information. I hope you can share some of those slides with us. That was incredible information. I've asked Susan, I don't know if you got my message, Susan. Are you queued up to go next, Susan?
I am certainly prepared to do that, sure.
Okay,
absolutely.
Very good. Susan Brown is gonna, I figure we keep the banks rolling here first, so we'll let Susan pick up from Sarah.
Very good. And if I could get a nod of head that you're able to see my slides at this point. Thank you so much. Good afternoon. My name is Susan Brown, and I serve as a Senior Vice President with Umpqua Bank, and I run the construction loan division within our home lending division. We are very long-term construction lenders. For about the last 20 years, we've been involved in providing loans to help build or renovate customers' properties. And some time ago, we gained a high comfort level with ADU financing, even before it became so popular like it is today. So for us, this involvement on a local level, as well as nationally, to try to help people understand our perspective on what we're doing is, we're honored to be here to share what we know. I would put Umpqua Bank into the conventional lending category. My colleagues on the panel bring some very unique and much needed financing options that can fill the gap that we can't fill. We're able to do more conventional type products, but all of us together offer a broad suite of available options for your clients. At Umpqua, we work with owner-occupied properties, which helps to mitigate a little bit of risk associated with multi-family properties that also have ADUs. It's just a smaller universe of properties that we're able to finance. We are able to work with internal ADUs, and I'm sure many of you from the prior sessions understand those differences. Internal is simply within the existing footprint of the house. We also are able to help with external ADUs, which are attached to the existing building, and then the separate ADUs, which are often called backyard cottages, casitas, a variety of different names, but they're detached from the main unit. A growing trend across the country, specifically in California, we're seeing options available for multiple ADUs on a single property. Our program allows for just a single ADU. That stretch to find financing for multiple ADUs is one of those things where the great idea is becoming ahead of available financing options. So that's a little bit tougher, but there are some organizations, I believe, that have that available. At this time, we're not able to offer that. We have a suite of products available for customers who want to build an ADU. For folks who have an adequate amount of equity in their existing property, a home equity line of credit might be a really good choice. That's just simply a line of credit, works a lot like a credit card, but it's attached as a lien against the house. It's established for a particular credit limit, and then you can borrow up to that amount and pay back over time. One of the cautions that I offer when people are considering the home equity line of credit is to make sure that it has sufficient funds available to get your entire project completed. One of the dilemmas that some homeowners run into is they get partially complete with their construction project and then seek financing when a lot of work has already taken place. And there are very, very few lenders who will lend on a project that's already started. So it would just be a caution to make sure that there's plenty of funds to complete the project with that line of credit. We're also fortunate to offer the home style renovation loan. That's a Fannie Mae product that allows for the renovation of an existing property and allows for all types of ADUs like we talked about just a moment ago. There are some accommodations in the home style product that will allow the use of rental income from that ADU, the proposed ADU. Those circumstances are really limited. So I would encourage you to talk with your lender who offers the home style renovation product so that they could tell you what those choices are for availability to use rental income to qualify. We also have access to the full suite of FHA 203K products. We have the limited, and that in some small instances could be used for an ADU, but there can't be any structural work associated with a limited loan. But with the standard 203K project, it allows for structural changes, generally working within the existing footprint, but there are some accommodations for additions to the footprint as well. But the modifications to the property can be quite broad, including things like repairing foundations and repairing wells also. So it's a way that they can do some major upgrades to their property while they're adding an ADU. Finally, our all-in-one custom construction product is the product we use most often for our construction and renovation projects that can accommodate all of the types of ADUs that we talked about. It gives us a little more flexibility to do some kind of unique things, but still not as ingenuitive and innovative as the other two speakers who are talking today. They've got some accommodations that I certainly wish we had too. With the construction program, and Sarah reflected on this in her comments earlier, there's a borrower review process just like every other loan that customers do. So there's the whole credit package that's typical for any loan transaction. We also conduct a builder review, again, to Sarah's comments, making sure that you have a tried and true and vetted builder to be a partner with your customer is essential to make sure that that project is going to be able to come to fruition. And finally, we do a project review where we look at all of the exhibits up front. And in fact, we pass those exhibits off to our partners. Abdur happens to be in my community in Portland, so we've had occasion to be in touch in the past. And we would send all of these exhibits to the appraiser to have them take a look at the comparable sales and let us know a value for that property. With all of our construction loans, the customer will make some type of a payment during the construction period. Some of the products we have are a full principal, interest, taxes, and insurance payment during construction. Other products are an interest-only payment. And then all of our loans have a permanent feature that once the construction is complete, they will continue on as a permanent loan. The customer doesn't have to refinance unless they wish to. And that's called rolling to permanent status. I want to finalize my comments by offering some learnings about challenges. And I don't mean for this to wrap up on a disappointing note, but just facing some of the realities that we have when it comes to construction lending broadly, and then in particular related to ADUs. The first I mentioned before, that we are able, for our program, we're able to do a single ADU and not multiple ADUs. So as lenders out there are considering their options for developing a program or trying to use us at Umpqua Bank, just to be under the realization that we just kind of entertain one. There's been a lot of conversation about condominiumizing ADUs, where they will ultimately split the lot and create a condominium that would encompass both the main home and the new ADU structure. So we're beginning to have conversations about how financing would work in that scenario. And it's becoming very popular in the Seattle market. So I imagine people will be looking to that market for some learnings as we go forward. Probably one of the biggest hurdles that we have is in most instances, we're not able to include future rental income to qualify a borrower for the ADU development. That's a roadblock for a lot of customers, and one that we continue to explore different methods that in the future, maybe we will be able to include that rental income. The appraisal, which Abdur will talk about in a couple of minutes, is a challenge, not insurmountable, and with a very highly skilled appraiser, not quite the roadblock that some people might anticipate. For Umpqua Bank, we do owner-occupied properties only when we're building out a new ADU. So we have yet in the future to add the investment properties, which possibility that we could do that someday in the future. With the Fannie and Freddie affordable programs that I mentioned in conjunction with home style, there are some limitations on the income, but the good news is that they have some accommodations for low and moderate income borrowers that we can include some of that rental income. So that opens up a little bit of a window for a select group of customers that we might be able to serve. That is the end of my comments. So I will stop sharing my screen and we can have the next speaker go forward. Thank you very much.
I want to make a quick change. We had planned on having Abdur go next, but I think Desiree made a great point. Have all lenders go first, and then we'll have the appraiser go last. So you can hold off if you don't mind, sir. In which case, we'll let Desiree, that's the correct pronunciation, take us away if you don't mind, please, ma'am.
Okay, let's see if my screen share can work. All right, I see it. Do you all see my screen?
Not yet.
Not yet. Okay, hang on a moment.
And while she's queuing it up, okay, she's got it. Susan, you're going to share your slide deck as well. Outstanding information. Thank you so much for sharing that with us.
All right, can you see my screen? Great. And then I wanted to say a quick note of gratitude to my other panelists. This is a small community of folks that have been trying to figure out how to deliver these ADUs for a while, and we've all been relying on each other over the past couple years, it feels, to learn some of these lessons and to share what's been working and not working and what each of our lending institutions are allowed and not allowed to do. And so I look forward to ongoing collaboration, but thanks also for everybody's good work thus far. I'll talk a little bit about who Craft 3 is and then how we designed our ADU loan product and some lessons learned. We are a nonprofit community development financial institution. We are not a depository bank, we are just a lender, which means that we have a mission. We serve the Pacific Northwest, Oregon, and Washington, and we do that through a variety of business loans and consumer loans and loans to nonprofits and a wide array of loans. But our capital, we don't have deposits as our capital source. We bring in capital from a range of other sources, whether it's from private sector, public sector, grants, loans, etc. And so when we are thinking about serving a community need or meeting a need with our loans, the question about what capital sources we could use and what pricing that we could offer the homeowners is always another factor that we have to consider. And that's been an interesting challenge with ADUs because of the economics of them. How do we keep the rates low enough to make everything pencil for all the parties involved is one of our ongoing challenges. I'll just skip through a couple of these background Craft 3 slides. So we, for many years, have been offering kind of small consumer loans for septic system repair and replacement, for home energy upgrades, more recently to help people repair and replace manufactured homes. And in this context and all the work that we've been doing in communities, the need for support and financing for ADUs has been, folks have been asking us for a long time, can you help with this? Because other financing products haven't been quite working. And so a couple of years ago, we set out to figure out a loan product that would work to meet the gaps in the market and be able to deliver financing affordably enough to support that homeowner to rent to a low-income household, or for a low-income household to be able to take out an ADU loan and generate some income. So when we went to design our product, we investigated all the different options and where the needs were that we saw out in the world. And we have been trying to avoid a standard construction loan as much as possible because they're expensive to deliver. I think Susan talked through all the different reasons why they're good loans, but they're also expensive. And we're trying to see how can we streamline our costs as much as possible. So we offer a home loan secured by a deed of trust that can finance the design, development, and construction of an ADU. We've had to be pretty creative because people really do need construction loans, and we've been trying to kind of work around and find a way to deliver a construction-ish product without it being a formal construction loan. We have two different tracks right now that we offer, although that could change in the future. We designed our loan in context of a lot of programs that we're trying to get up and running, both in Oregon and Washington. Not all the programs have come together as quickly as it was for us to internally design a loan product. because the loan product design is easier and faster than bringing a million partners together to do all the wonderful coordination that we've been hearing from all the other panelists. And so we launched what we've been calling our standalone loan, which is just our own loan using Craft 3's capital. And then we also have partnered with Back Home that you've heard in the previous session, and they were able to take some of their funding and invest it in Craft 3 in order to draw down the interest rate. And the tenants required from that program are required to be lower income, so up to 80% of the area median income. And Back Home is a full service, one of the full service programs that helps the homeowner from soup to nuts navigate finding a unit, going through the construction process. And then there's property management services too that are part of that work. And that is a nice package to provide to homeowners. And then in exchange for all those services and the reduced rates, the tenants, whether it's friends and family or a unknown third-party tenant, they all have to qualify as earning under 80% of the area median income, and the rents are restricted. We've all been talking about the various mission impacts that the ADU loans can bring to communities, and we are interested in all of them because they all serve the communities that we've been working with. And I think as time goes on, we will learn more about which of these mission impacts are coming up more frequently than others. But our goals, we want to just build housing, have more units of housing, and have as many of them be as affordable as possible, support or reduce displacement risk, and support homeowner stabilization. We're also seeing a lot of need for multi-generational housing and assisting whether it's seniors or kids that have graduated college and moved home, in a whole variety of ways that folks need to house their friends and family, particularly in that last year. So I talked a little bit about our product. I'll go through the other features. We also are only supporting owner-occupied single-family residents. We will make an adjustment if there's a direct family member living in the primary residence that's not the owner, and they want to rent out the ADU. We are willing to work with that. Right now, we serve Multnomah, Washington, Clackamas counties, which is the Portland metro area. And with additional capital and partners, we will expand throughout the Pacific Northwest. Our loan, we will offer up to $250,000 for a standalone Craft 3. Back homes are limited to $150,000 in order to keep that monthly payment affordable. Some exceptions may be approved. We don't have an exact opinion on a 1 versus a 2 ADUs in the backyard, but the likelihood that the kind of borrower or applicant that will come to us to be able to put 2 ADUs in their backyard, given the overall state of their finances, is not highly likely at this time. We had one applicant that their home was valued at $300,000 and they wanted to put $400,000 worth of ADUs in the backyard. And for us, that's more of a commercial loan than that is really a home loan. Our rates are fixed. We offer reduced rates for lower income applicants and also reduced rates for back home participants that are going to rent out their units as affordable housing. We increased our term up to 20 years to keep those payments low. And we have a very generous forbearance for the first payment to accommodate long construction timelines. When we first started offering ADU loans, the timelines were looking 4 to 6 months. But now, because in Oregon, there's been fires and COVID has exacerbated people's desire to do home improvement projects, that timeline has expanded a lot. And so we've had to go back and make some adjustments there. I have another slide to go into more details about underwriting, but we will accommodate more risk than a traditional lender, higher loan to values, higher debt to incomes, and we'll tolerate subordinated lien positions, even third position if it's behind a small HELOC. We also don't increase our rates for lower credit scores. So if you're approved at a rate, that's your approval rate, regardless of As long as you're approved, that's what you get. We also don't outsource to third-party service. We service everything in-house, so we don't have third-party debt collectors, and we don't report to credit agencies. So that's another way to kind of reduce the risk and bolster that homeowner's financial stability. And contractor-wise, we also do have a vetting process for contractors, and we need the contractors selected to prove that they've done projects within the budget that our borrowers are looking at. There's a lot of 400,000 ADUs in the Pacific Northwest, and we don't want someone who's accustomed to that to promise they're going to deliver one at $80,000 and then leave our borrower in the lurch. And then this slide goes through some of the ways in which we can be flexible in our underwriting. These are some examples. And for us, really, it's about not too much layered risk. So we could accommodate a lot of these things, just not all of them all together. So higher loan to values and higher debt to income ratios. We will either go by the appraised value or a simple desktop appraisal, depending on the overall picture of the project. We don't require an appraisal unless the homeowner needs that appraisal in order to get the right amount of money approved. We are okay managing some past derogatory issues. We generally de-emphasize credit scores because of their history of inequity and because of the equitable lending we are trying to do. So we can accommodate low scores and things like income disruptions, particularly nowadays. And then we do consider the intended ADU use in the underwriting, but depending on that homeowner's plan, we may or may not consider that rental income. We have to determine that on a case-by-case basis based on that homeowner's plan. And then here's an example of one of our earlier borrowers who have completed their ADU. This is a unit from Wolf Industries, which is our partner on the Back Home program. They used to be able to generate an ADU in about 3 or 4 months from deposit to installation, and their timeline has extended now, but they're highly affordable, pretty high quality units. And then, like a number of our approved applicants, they were able to get some money from an equity loan or some money from a loan, but just not enough to cover the full cost of their ADU. We also see folks either have new homeowners that don't have enough equity in their property, or they have lower incomes and quite a lot of equity in their property. And so those are kind of examples of folks that we could really work with. And then my tips and lessons learned are pretty much the same as everybody else's, that financing is important. You can't have a program without financing, but there's so many other factors to helping something be successful, and financing is one piece. And it takes a lot of time and flexibility and creativity to pull all the partners together and have a comprehensive program that works. And then for the cities and counties and potential funders out there, that is a great way to support ADU growth in your region, is to help all those entities have the time and money to be able to come together and bring something out there. And then learning the needs of the homeowners and builders is really important. We've seen a lot of programs that didn't know enough about what the homeowners need and just design something that wasn't quite the right fit, and then had to go back and adjust. And then I think my final biggest takeaway here is that the economics can be pretty tight. Either you've got high rental, potential rental income, but then your construction costs are high. And then in the places where the construction costs are lower, the rental potential is lower. And so if you want to achieve, support lower income households in building wealth and rent to lower income households, those are really great goals to have, but they require a bit of subsidy to have enough cushion for everybody, for it to pencil for everybody and pencil comfortably. And so really thinking through that homeowner pro forma and that renter pro forma is important in designing the program and the financing needs. And finally, we just need more examples and more storytelling to convey those benefits and to help other lenders figure out how to join the market and to help cities and counties and other nonprofits determine how to jump in and add this to their tools to create and enhance affordable housing, whether formal affordable housing or naturally occurring throughout all of our regions. And that's it. Thank you.
Good job, Desiree. We've got some real good examples of lenders who have the flexibility to do ADU financing, which is outstanding. Now I'm going to hear from an appraiser because we know that's one of the key pieces to getting all this done. Mr. Abdul Malik will walk us through his approach in terms of how this can work with appraisals and ADUs. Sir, the floor is yours. And before you start, Patty had your hand raised. Not sure if you had a question or not, but we're going to get to all the questions in about 15 minutes or so, Patty.
Okay, so my name is Abdur Malik. I am a certified residential appraiser that's based in the Oregon and Washington area. Are you able to see my screen? Can I get a nod? Okay, so let me go ahead and begin the presentation here. And let me switch that around. So I hold two major appraiser designations, the SRA and the ASA designation. I'm a blogger on a variety of platforms. I've been studying the contributory value of ADUs. Spent a couple of years working for a nationwide appraisal management company, which gave me a wide angle lens for the lending environment throughout the country. And I'm an advanced Excel user, and I am studying data science techniques. So one of the most important things to do is to go to definitions. We've probably been exposed to these definitions before, but it doesn't hurt to review it briefly. So this is from the Fannie Mae Selling Guide, and this is how they define an ADU, which is very important for the appraiser. They say that it's an additional living area independent of the primary dwelling unit. It includes a fully functioning kitchen and bathroom. Some examples may include a living area over garage, basement units. Now, whether a property is defined as a 1-unit property with an accessory unit or a 2-unit property will be based on the characteristics of the property, which may include, but are not limited to, the existence of separate utilities, a unique postal address, and whether the unit is rented. So here's the key. The appraiser is required to provide a description of the accessory unit and analyze any effect it has on the value or marketability of the subject property. A lot of this comes down to what's known as highest and best use. A highest and best use is something that an appraiser does to determine what is the most profitable use for property when you factor in legality, zoning, and various other characteristics. Sometimes people just say to appraisers, well, can't the appraiser just call this property a duplex or a triplex and just be done with it? Well, there's a problem with just painting everything with the same brush. Richard Hager, he's a nationwide teacher of appraisal theory. He's an SRA as well. And he likes to say that appraisers need to do a righteous highest and best use analysis, which means you really have to dig in deep and you have to do due diligence. Now here in Portland, Portland, Oregon permits a person to rent not only the ADU, but also the main property, but in some municipalities that may not be the case. But the key is that sometimes if an appraiser were to look at a ADU property and a single family property and just say, oh, well, it's a duplex, let's call it a duplex, it could result in a diminution of value of the property. So an appraiser has to be very sensitive to look at a property from all the important angles. And sometimes it's extremely easy to characterize whether a property is a duplex. Here at the top, we have a symmetric property. Very easy to call that a duplex. Certainly, I would agree with that. But here below, we have a major dominant unit and then a truly accessory unit. So that's pretty clear. But in some cases, it's very ambiguous. And that's when the appraiser has to really dig into the data to see which way the market will reward the property in its interpretation. Now, I know that appraisers can be the fly in the ointment with many of these programs. And so I have given presentations to fellow appraisers about appraising accessory dwelling units. And I always tell them, please, please, please don't be the $10,000 guy. There are some appraisers who just phone it in. I'm not throwing my profession under the bus, but I am acknowledging that there are some problems in valuation. And you can get a great appraiser and the transaction can go through smoothly, no problems. But then you might get an appraiser who maybe is a little bit outside their depth. They kind of just throw up their hands and they say, well, I'm just going to say this ADU is worth $10,000. Now, I know that this has some very important real world consequences. It could derail a loan. So I again plead with my fellow appraisers, please don't be the $10,000 guy. It can help to keep costs in mind. Now here in Portland, we actually have a very favorable regime for building ADUs. And in fact, we have a national ADU expert who puts on tours periodically for homes that he helped an ADU get constructed for. Back in 2019, before COVID, I actually participated in one of those ADU tours. So I drove around all of Portland looking at these various homes, but I just want to draw your attention to the cost line. This one, $157,000. This one, $126,000. This one, $203,000. This one right here, $380,000 is what they had to pay to get that ADU. And the second page of some of the other properties that were on the tour, they're mostly ranging between about $175,000 to $230,000. In fact, the cheapest one on this entire list cost the borrowers $70,000 to construct. And that was a relatively simple one. So we appraisers, we do stress and we do caution that cost does not necessarily equal value, but cost can be a reasonable test for the upper limits of what that ADU should be contributing to the overall property. And I have said this to appraisers before. If you are writing a report and you are giving only a measly $10,000 a bump up in value to the property for that ADU, it better be the most awesome report ever written in the history of appraising. And it should be a report that can be archived in the Library of Congress for future generations to study. So what are some valuation tips? You know what? I always tell people there's no magical way to appraise an ADU. Appraisers have a multiplicity of tools with which they can approach valuation. There's three major approaches, but there's a lot of sub approaches within them. Now you can actually consider the income approach, which is an approach to value that says, I'm getting this much money. I can apply a standard formula. So this is what the property is worth. Now, almost 10 years ago now, there was an income approach study done in the city of Portland. And that study was very interesting. There's a hyperlink there. You can screenshot and take a look at that paper. The authors of that paper concluded that the income approach oftentimes overstates the value, the contributory value of an ADU. So there's correlation between income and value, but with ADUs, it's not exactly the causation. And this actually goes with Desiree's slide. There's a multiplicity of reasons why someone may build an ADU. It may be for income generation, but it could be for aging in place, for multi-generational living, as she mentioned. The cost approaches we previously mentioned absolutely can be considered. It may not give a dollar for dollar increase in value. In fact, in most cases, an amenity, an improvement usually doesn't give you a dollar for dollar increase in property value right away. There are some rare occasions where sometimes you pay for something and you get an even greater value out, but in most cases, it's going to be a fraction of that dollar you put in. One of the bigger challenges that I found with the cost approach is that you have to account for depreciation, meaning how much has the property worn down. And sometimes the ADU is so much nicer than a house. I say you're buying an ADU, you're getting a house thrown in. And so the depreciation can be very different between the main house and that beautiful $200,000 plus ADU. So what is the best approach? In my opinion, it's the sales comparison approach. That's where the rubber meets the road. You're saying, if I put this on the open market, how much could I reasonably expect to get back from a typical buyer? Now, appraisers typically are going to be appraising an ADU for a bank, and they often will go by the standards of the GSEs like Fannie Mae and Freddie Mac. But I like to point out that even though they have these guidelines that they want appraisers to follow, that's all they are. They're just guidelines. An appraiser can modify it if the valuation warrants. So what's one technique? Now, in an ideal world, an appraisal would have at least 3 similar sales that have closed within the last 90 days, but it's seldom that ideal with ADU analysis. A lot of times, and maybe this is for the underwriters that might be listening, you may have to relax those guidelines and be willing to see an appraiser grid a comp that sold maybe 24 months ago, 36 months ago. And an appraiser who is versed in valuation techniques should be able to do what's known as price indexing. He can say, or she can say, it's sold during this time frame, but I know the market is now here. Let me go ahead and apply a time adjustment to this older sale so that I can make sure I'm properly accounting for time in my analysis. Now, another technique could be resale analysis. I've had some appraisals where the subject was a very oddball property, but sometimes I'll notice that the property sold a few times on the open market. So what I can do is say, hey, every time this thing sold on the open market, the market seems to have given this percentage of an increase for this feature or diminution. Now, of course, with ADUs, usually it's going to be an increase. Another technique could be location. There is no rule that says your comps all have to be within a mile of the subject. That's a made up standard that sometimes lenders will apply. When appraisers are appraising atypical properties, it's not unusual to go miles out. In fact, if an appraiser is appraising something like a geodesic dome, they may have to go 25, 30, 50 miles out. Now, you're usually not going to have to go that far out with an ADU, but if you see a report where the ADU comparable is 3 miles out, you really shouldn't bat an eye if that's the best data that's available. Now, occasionally you just can't find a comp that really is comparable to the subject. So what you have to do is accept what's known as property variance. You're going to find a property that's not comparable to the subject, it's just really not comparable, but it has an ADU. So then what you're going to do is you're going to study that property that had this ADU, and you can say, okay, it actually contributed X percent in value. So now you have a market proven percentage adjustment that you can apply to other comparables in your report. And I like to point out that there are so many valuation techniques appraisers have. These are the names of a few. I use all of these from time to time in my valuation reports. A lot of times I'm leaning on regression, aggregate differences, or group paired sale analysis. Here are some of the graphs that might show up occasionally in my report if it warrants inclusion in the report. So my point is the data's out there. You may have to dig. The techniques are certainly there. You just may need to get an appraiser who kind of is comfortable with all this. And you may also have to realize that expertise may not come as cheap as some of the more normal appraisals. So you may have to open up that pocketbook to get the right appraisal. So I think that will do it for my presentation. If you have any questions, I'd be happy to answer any.
Wow. Thank you so much. You know, I came to this session with high expectations, but you four have exceeded those greatly. Thanks to you all. We've got some great questions already in the chat in the Q&A section. I'm going to start with Sarah. I think you've offered this answer the first question. How does a slow permitting process add a lot to the cost? So Sarah, you can take that one away if you don't mind.
Sure. Yeah. And thanks for the question. I mean, it can affect the cost. I suppose the cost could also go down, but for example, anytime you're, adding an additional element of time, you're adding the risk of a number of factors changing. So for example, interest rates can rise or fall, or in particular over the last year, what's really risen is the cost of construction due to increasing cost of lumber. So that's why I included it as an element that is undesirable when the permitting gets extended. I suppose it's technically true that you might end up with your costs reduced, but at least in our experience over the last year, what's ended up happening is that the costs are going up.
Okay, great answer. Mark, does that satisfy you? Do you want any more detail with that answer? I think we'll take that. Mark has another question for you, Susan, while we try to get the answer for that one. So Susan, I think you had a question about the one-time close header you mentioned. Any clarification on that, Susan?
Yes, I'll assume looking for a little more of a definition. Construction loans, true construction loans can be offered in two forms. One is called a one-time close. One is a two-time close. With a one-time close, the loan documents are written in such a way that they incorporate both the construction period and then the permanent financing period. The loan rolls over to that permanent phase without having to modify or refinance those loan terms. A two-time close is when the loan is specifically and only for the construction phase, and then the customer needs to find permanent financing with a different loan. So they're generally refinancing either with the same lender or a different lender to get that final construction loan.
Okay, excellent. Thank you so much for that, Susan. And I know we'll have more questions. You guys have to be available for other folks with questions because this has been so great. And we only have so much time left, but I want to continue the discussion. Mark has one more question about, and this is a great question. I don't know who can answer this one, but he says these lending programs are so exciting. Any tips on how to find equally friendly loans local to the Raleigh-Durham area? So this is the $1 million question. You guys are doing great things out on the West Coast and other places, but what about right here where we live? Any responses to Mark's questions about that? And let me ask Sarah. Sarah, I know you self-help is actually national lender. I don't know if this program is available all over, but maybe you can tell us about whether there's any chance that we can share some of that West Coast love over here in RDU area.
I mean, I think it's certainly possible. I cannot, of course, commit to anything on behalf of my colleagues, but certainly we have, experience to learn from that we're more than happy to share. And of course, our North Carolina colleagues are aware of this pilot. I should also mention something I didn't mention in the presentation, which is that this LA pilot is now kind of in a runoff mode. So it's closed to new applicants. And in the meantime, we're launching an expanded version of it up in Oakland in partnership with a funder up there. So the announcement's not yet public, but there'll be a formal rollout of that soon. So I share that to say that, self-help continues to explore this. I think what makes it easier to attract a lender, whether it's self-help or another one, it really depends on what the target population of homeowners you're working with is. For us, as some of the other panelists have alluded to, when we're working with low and moderate income homeowners in particular, an element of subsidy is really crucial. So for us, that's why the next phase of our pilot is going to be in Oakland, because we have connected with a philanthropist that's really interested in supporting that work. So I would say for folks, whether in Durham or anywhere that are listening, try to connect some of these dots and some of these pieces in advance, either for the funder, or if you find a funder who's interested in this kind of work, then finding some of those other partners, because that's what has pulled together now both iterations of this self-help pilot. And I think that it makes it easier to make that case, whether it's to a lender or to a philanthropy group or whomever, when you already have some other high quality partners on board.
So the love is spread from LA to Oakland, and we'll have to wait and see how far it goes. Any other thoughts from our panelists about how we can find these kinds of options close to the home?
Yeah, Amir, this is Susan again. I think not every lender, and again, I'm speaking from the conventional perspective, not every lender offers construction lending, but if they do offer construction lending, the chances are good that they would entertain an ADU project. So I would check with local credit unions. Some of the larger regional banks have also been engaged in construction financing. It's harder to find, they're not everywhere, but those would be the ones that I would check out first, is kind of those regional banks, and then also local credit unions have had some experience in those areas.
Okay, great answer.
Yeah, and my 2 cents that I will add to that is to, in that work, understand some of the barriers that your local lenders will face and where they identify the risks, because there are ways that either the public sector or the private nonprofit sector could help offset some of those risks to make it possible for some of the more conventional or credit union lenders to be able to fill that niche. If they just have, whether it's a loan guarantee or something else, there might be some ways to move forward even in a conventional lending environment.
Excellent point. And if we can take Mr. Abdul Malik with us, we can go and fight with these lenders about the appraisals too, because that was some great information there. One more question for, I believe is for you, Desiree. It's about Craft 3 and whether you guys have a standalone product. Does it have income restrictions for renters or particular target demographics for homeowners? That's for you, Desiree.
Yeah, that's a good question. And so we do not have restrictions. That loan product has a higher price point on the interest rate. And so we reduce the interest for lower if the applicant for the loan is under 100% of the area median income, they qualify for a reduced rate. And so how our philosophy is that there is a wide variety of people that lack access to financing, and we don't want to limit that pool, but we want to create greater incentives for folks that might have a harder time to afford that financing. So we'll have different ways that we can incentivize or support a lower income household, but we make that loan available universally. We don't have necessarily a restriction on the use of the property either, although there are programs in the city that make it such that those restrictions come from other places, because there's a waiver of different charges if you don't offer it as a single, if you don't rent it out like on Airbnb. So we don't have to be the regulators of those things, but there are other controls out there that help us avoid some of those other situations.
Great answer. Well, I want to thank you guys. This has been phenomenal. So much information, so clear. I hope you can share the information with us. And I encourage all of us to continue to reach out to the panelists and to each other and network, use the app. This has been a great way to end this session. So thank you guys for great demonstrations. Thank you. And I believe we've got a break coming up here. So next session will be 10 minutes of networking. So thank you all.
Thank you.
Thank you.
Thanks, everybody.